Hey YouTube. Recently, while I was watching an episode of Jim Cramer show Mad Money, I came across this episode where he talked about the rule of 40, but this was a modified version of the rule of 40. The usual rule of 40 is not tied to valuation, so while it's a useful indicator of checking out how fast a company is growing relative to its profit margin, it doesn't tell you anything about how that ties in with the valuation of the company. So recently, he showcased this new modified rule of 40, and I want to talk about it in this video. So the new rule of 40 is different in that it has a few things that are different from the traditional rule of 40. One of them is that instead of using a profit margin, now EBITDA margin is used. So the EBITDA margin tends to be a proxy for cash flow. I think that's a good change because for growing companies, a lot of their profits are reinvested into growing the business. So the net profit margin may not be a very accurate representation of the true profitability and cash flow in the company. So the EBITDA margin, I think, is a good substitute. You could also perhaps use the free cash flow margin. And so it's the second part actually that ties it back to the valuation. So it says that the addition of the revenue growth plus the EBITDA margin should be at least 5 times or more the size of its price to sales multiple. So a lot of these companies don't have reasonable price to earnings multiples because their earnings can be very low. So it will not be practical to use the price to earnings ratio. But you can still use their price to sales ratio to get an assessment of their valuation. So let's put that to the test. I just want to add that this rule can be a little subjective. For example, instead of revenue growth rate, instead of looking at the total revenue, for some companies, especially SaaS companies, software as a service company, may want to just look at the recurring revenue growth rate. Instead of the EBITDA margin, as mentioned, you could look at the cash flow margin or the operating margin. And 5 times does seem a little subjective. I know in the previous episode, Jim Cramer actually used 10 times. So now he seems to be a little more stricter about the valuation. But 5 times still seems a little subjective. But nonetheless, I think it's a handy rule, and let's try it out on some companies. So let's try this out first on one of my top holdings, Amazon. So on this website, finviz.com, you can find out a lot of information about the stock. So first of all, we need the last revenue growth rate that was recorded. So we can see here that it was about 26.40%. Next, on morningstar.com, we can get the EBITDA margin. So let's take a look at that. So we can see here that the EBITDA margin was 12.45. So 26.45 being the revenue growth plus the EBITDA margin of 12.45 equals 38.85. So it falls just short of 40. So it doesn't pass the first rung of the test. Nevertheless, let's see if it passes the second rung of the test in terms of valuation. So the price to sales ratio currently is about 4.39. So 38.85, which was the result of the first part, divided by the price to sales multiple 4.39 gives us about 8.84, which is considerably higher than 5. So it does pass the second rung of the test in terms of valuation. Let's try out the rule with one more company. This time we'll use Shopify. So Shopify had a growth rate of about 46.60% in the last quarter. Next, let's take a look at the EBITDA margin of Shopify. So over the last 12 months, Shopify had an EBITDA margin of about minus 7.84. So when you add the revenue growth rate to the EBITDA margin, which is negative in this case, you get 38.76. Now let's take a look at the price to sales ratio, which is 53.38. So when you take the result of the first part divided by the price to sales ratio, you get 0.72. So this is way below 5, the required 5. So Shopify fails both rungs of the test. It did not reach 40 and it did not reach 5 or more. I know there are a lot of tailwinds behind Shopify now, but it does seem very overvalued. Of course, things can change. The revenue growth rate could suddenly increase dramatically from 46 to a much higher number, and that will push up this number over here. It could also suddenly turn a profit, and that again will push up this number over here. And when the revenue increases dramatically, that will push down the price to sales ratio, assuming the price doesn't change. So that will push down this number over here. And overall, that will increase the answer that we get. But this modified rule of 40 does seem a quick and dirty way to quickly assess companies based on their growth, their EBITDA margin, and then to tie it back to valuation. I'll probably try out this rule on some of the other companies I own just to get a sense of where they stand on this rule. Of course, I won't make investment decisions based on just this rule alone. I look at a lot of different factors when investing. But I do think this is a useful metric to keep an eye out on. What do you think about this rule? Let me know in the comments section. If you would like to be a patron and a supporter of the channel, jump over to our Patreon website and you can subscribe to one of our membership levels. You can also gain personal access through me and also my immediate thoughts and actions in the stock market through Discord at about $5 per month. We look forward to seeing you on the Discord chat.